Ever get hit with an expense that technically wasn't a surprise, like car insurance, holiday gifts, or an annual subscription, but still somehow wrecked your budget? There's a simple fix, and it's called a sinking fund. Here's the concept. A sinking fund is a small savings category for an expense you know is coming, but doesn't happen every month. Instead of getting blindsided once a year, you save a little bit toward it every single month, so when the bill arrives, the money is already there. This one shift, from reacting to planning, is what separates people who feel constantly ambushed by their own budget from people who feel calm about it. Let's use a real example. Say your car insurance costs $600 a year. Instead of scrambling to find $600 in 1 month, you set aside $50 a month into a separate sinking fund. When the bill comes, you're not stressed. You already have it covered. This works for almost any irregular expense: holiday spending, birthday gifts, car maintenance, annual subscriptions, even vacations. The pattern is always the same. Take the total yearly cost, divide it by 12, and save that amount every month. You can apply this same math to literally any predictable expense, no matter how random it seems at first glance. Here's why this is so different from a regular emergency fund. An emergency fund is for the unexpected, things you can't predict. A sinking fund is for the expected, things you know are coming, just not exactly when. Mixing the two together is one of the most common budgeting mistakes, because it makes both funds feel smaller and less reliable than they actually are. Setting one up is simple. Step 1. List the irregular expenses you deal with every year: insurance, gifts, car costs, subscriptions. Step 2. Add up the yearly total for each one. Step 3. Divide by 12, and that's your monthly sinking fund contribution. Step 4. If your bank allows multiple savings accounts or buckets, create a separate one for each category, so you always know exactly how much is earmarked for what. The biggest benefit isn't just avoiding financial stress, it's avoiding debt. Most people who go into debt for something like car repairs or holiday spending aren't bad with money. They just didn't have a system that saw the expense coming. Once you set this up, expenses that used to feel like emergencies become just Tuesday. Nothing dramatic, just a bill you already planned for, and the peace of mind that comes from never being blindsided again is worth far more than the small effort it takes to set up. If this helped, subscribe. Every week, one simple money lesson. No jargon, no hype, just what actually works.